first of all, let me say thank you very much. I really appreciate everyone being here today, especially on such a beautiful day. I think we had very few fall offs on the first one of these at 10 o'clock, but I think the day is so beautiful. We had a lot more no shows this evening, so I appreciate those of you who found time to make it here. So, when we talk about this, I get a lot of questions. We've been doing this for about a year now, quarterly, and I get questions from people like, hey, is it hard to think of topics, or like, how do you do this? And I'll tell you, it is absolutely easy. You would be surprised how obvious these things are. So the 4 that we've done was right after COVID, right? That one was of course really easy. All right, and then it was the rebound. Everything was rebounding pretty fastly, so or pretty quickly. So that was pretty easy, to discuss. And then you had the election, was pretty close after that. So we kind of had, hey, here's what the election is looking like. Here's where you might want to, have your portfolio or position yourself. And then right, of course, afterwards we had, okay, it looks like Biden actually won and he's going to be inaugurated. So, what are we going to do now? And of course, now, it again, I think was really obvious. Everyone is asking the same question, which is the market is so high that, we've got some inflation. We're doing a ton of stimulus. Does it really have anywhere to go but down? Right? It is by far the number one question I've been getting from everyone. And so have the other advisors in the firm. So that is what we're going to talk about today. I think, again, if everyone keeps muted, that would be great throughout this time. I'm happy to answer questions as long, I was here for over half an hour this morning answering questions. So as long as people have questions, I'm happy to answer them. Or of course, you guys can always send an email or give us a call afterwards if you feel more comfortable doing so in in a more private environment. So I think that this slide does such an amazing job of telling us what is actually happening and why we're getting all these questions. So this slide goes all the way back to 2013, but I really want to focus on, kind of from here out, so from 2019 on, what has been happening. And if you even kind of put your hand over it, right, you look at it and you're like, oh my gosh. So a lot of people think when they first saw this, I was kind of, I talked to the staff at AQuest about, what we're going to talk about. And most people thought this was like Bitcoin or some super aggressive tech company or a Tesla stock or something like that. It is not. This light blue line here is just the NASDAQ, right? Nothing terribly exciting. I mean, it's more tech heavy, but it's certainly not the most aggressive thing out there. This blue line is the S&P 500. I mean, it includes old kind of stodgy growth companies like, Ford, Coca-Cola, General Electric, nothing too terribly exciting. LPL, actually the company that I clear through, we just got on the Fortune 500 at number 466. That we're not like this super amazing growth company, LPL, right? I mean, they're a pretty conservative play. These are small caps, and the Dow, I mean, mid caps. So these, again, if you kind of look from here on out on what they've done from the beginning of 2019 till now, this is why people are concerned. It is because of this that everything looks so high compared to where we were a couple of years ago that they're saying, what in the world, kind of like, where are we and what do we need to do now? And people are tending to kind of fall into one of two categories, right? Category number one is, hey, everything's great, let's be super aggressive. And category number two is, hey, everything's going to crash, obviously, so we need to be in cash. So when there's times like this that everyone kind of falls into camps, I think using, going back to some typical rule of thumbs can make sense. So if we can explore some of those, investing strategy 101, buy low and sell high. So a lot of people, are saying, hey, my whole life I've heard buy low and sell high. I mean, if anything that I own now, aren't we just basically buying high, right? We're not buying low. So isn't now the time that we should potentially get out? We'll explore that a little bit later on. But, also Warren Buffett. So I think that's another great, like, kind of rule of thumb type of guy, whatever he says, because he is the world's most successful investor of all time. And when I say that, I think a lot of people will say, well, what are you talking about? How is he the world's most successful investor? I think the difference is of most of the really rich people in the world, they made their money starting a company that made something, right? Bill Gates and Microsoft and Windows, right? Even Steve Jobs and the iMac, the MacBook and the iPhones and iPod, Bezos and Amazon, Elon Musk and Tesla, right? Most of the really rich people have a company that did something totally different. Warren Buffett is still, I think, top 10 richest in the world. and he has never created anything. All he does is buy the shares of stuff other people create. So that's why I think he is the most successful investor of all time. And he says, never lose money. And rule number 2, do not forget rule number 1, do not lose any money. And a lot of people are saying today, I've also kind of lived by this rule of thumb. Now that the market is so high, what do? I feel like the only thing I can do is lose money. And there's some other people that say, you know what, don't worry about it. There's no problem. The market will probably just continue to go up like it always does. So don't worry at all. Right. So we're going to kind of from here explore like some of the more optimistic people and about the market, and some of the people that think that things only have room to go down, and kind of why they think that. And then we'll talk a little bit more about some of the strategies for a super high market, and if stocks and bonds are elevated in valuation, some of the things you might want to think about investing in. So there are the people that say the market's going to continue to go up, right? And they say a couple of different things. Number 1 is earnings. Earnings are absolutely skyrocketing. So Apple, right, is of course one of the largest companies in the US stock market. It's worth over $1 trillion. I mean, just unfathomable even 10 years ago that a company would be worth that. Their most recent quarterly earnings. Now, Apple does not make huge things, right? They don't make cars, they don't make houses, they don't make industrial equipment. They make things that cost anywhere from, a couple $100 to a couple thousand in their computers. iPads, iPhones, things like that. I mean, they're $1,000 max. And they had $111 billion in revenue in one quarter. It's ludicrous. It's ludicrous how much money that is. And that is 21% higher than it was this quarter last year. And most people are kind of think that this next quarter is, because of course that was kind of the meat of COVID and all the shutdowns, is going to be even more. So when people say earnings are great, so the stock market is going to be good, I'll give you the best example that I kind of what that means. When I was in business school, so a long time ago, I was always astounded. I was just getting into the, understanding how stocks worked in businesses. I was always astounded. So, I'd be in school and I would hear, okay, Coca-Cola missed their earnings by 1 penny. And as a result of that, their stock is down 7%. And I would think, holy cow, 1 penny leads to 7%. And that leads to the kind of the explanation of what is a stock, right? I think everyone knows a stock is a piece of a company, but what is the value of that company then? And what drives the valuation of that share? So a little bit more specific of a definition, I think, is that a stock is the net present value, the value today of all of the future earnings that those shares are going to have, right? So it's not the company that's worth anything, it's the earnings it generates that are worth something. So if you think the earnings are going to be X, and even though they only miss by a penny, that's a penny per share, and there's a lot of shares. So you go from X to Y, and you think, okay, now I'm going to earn less money per share on all of the shares in the company forever, right? That drastically changes the valuation, the net present valuation today. So when earnings are good, the opposite happens, right? When you're up 21%, you go from here to here, right? And then the stock now has a ton of extra value, and that's what's happening. So the mother's milk of stocks is profits and earnings, and they look great. So that makes people very optimistic. Also, some reasons is I think a lot. There's a rule of thumb that says sell in May and go away, and they kind of come back and buy in September. I've always thought that was silly because it's almost never true. 70%, 2/3 of the time that the summer, the stock market actually makes money over the summer. So I think people are starting to kind of come around to that and realize that. So that makes them pretty optimistic. And the presidential cycle, you can like or dislike Biden, and I don't think we're here to talk about that today. But most of the time, when the president's party is also in power in the Senate, even by the slimmest margin, and in the House, even by an also fairly slim margin, you can still get some of their ideas through that wouldn't get through, if Mitch McConnell, was in charge, and he was, and he had the majority, in the Senate. So some ideas are going to get through, and that generally means spending, when you're talking about the Democrats. So they want to tax people at the very high end, and they want to spend that money, and they're not shy about doing it in deficits. Again, that's not a knock on Democrats. It's just saying what it is that they tend to, especially this cycle, are talking about. So, spending is good for the economy, right? It keeps the economy going, right? All of the stimulus. You throw in there low interest rates, the Federal Reserve stimulating, low unemployment, and kind of just like an overall stimulated stock market, right? With a ton of stimulus. The people that think the market's going to go up feel pretty comfortable, So, and in that case, that's great. But I think in the back of their mind, they're still a little bit worried, and we're going to talk about some things we can do that have a lot of upside, but also, may be able to have some downside protection. Then you have the people that think the market's going to go down. Jason, obviously the market is going down. Go to the bottom first. There's all markets at all-time highs. We're doing all of this stimulus that's going to dry up at some point. We're doing all of this, kind of like keeping interest rates down, right? The Federal Reserve has a big part in that by buying up all the bonds to keep rates down. So they're going to stop that eventually, and they're going to do what's called taper. If you remember from a couple of years ago, they started tapering after the 2008 recession. It was called the taper tantrum. The market went down and bond interest rates went way up. So there's going to be another taper tantrum, and then inflation. Inflation has not really been a problem for almost 20 years. The government has done a very good job, along with the Federal Reserve, of keeping inflation down. Going all the way back to 1981. For those of you that remember, Ronald Reagan just became president a year before. Paul Volcker was the Federal Reserve chairman. And, they basically got together, caused a recession on purpose. For those of you in Michigan, it was a very severe one. The automotive company got killed. My dad was a builder. He didn't sell a house for 2 years. So it was bad, but they fixed inflation, right? It really has been almost not a problem at all since then, right? In 40 years. So now we're starting to get some inflation. Inflation could be as high as 3.5% or 4% this year. We've been at almost zero for several years, and the Federal Reserve is okay with about 2%. Now we'll talk about that a little bit more, but the people that think it's going to go down think inflation is really going to hurt us and kind of drive it down and drive the market down. So those are kind of the reasons that the market might go down. I'm going to come back to this later on as well, but what I would say is, no matter what you think, if you think the market's going to go up and it comes down a little bit, a lot of times the super aggressive people get jittery and then move to cash. And the people that think that the market is going to go down just have a natural inclination to go to cash. And it's kind of the easiest thing to do. So think about the decision to move some of your money to cash or more conservative, right? You wake up, the market's a little bit shaky, something happens that makes you uncomfortable. Powell, the chairman of the Fed, says something, who knows what happens, and you'll go, okay, I'm uncomfortable, I'm going to pull my money out. I've made a lot over the last couple of years. This is a great decision. You go home and you tell your spouse how smart you are, and everyone sleeps like a baby, for 3 days. And then 6 months later, the market's up 7%. And you go, ooh, well, I missed that 7%. But if I went into cash 7% ago, and I was uncomfortable then, I certainly can't be comfortable with these new elevated multiples. So you stay in cash for a little bit longer. Market goes up a little bit more, and you say, oh, if I was uncomfortable 10% ago, I definitely can't invest today. And so getting out of the market is the easiest decision you'll ever make. Getting into the market is torture. You're either buying at a higher valuation than you sold at, and now you hate yourself, or it's a big recession, even though that's what you've been waiting for, but now you're uncomfortable and you've got to try and pour all of your money in when the world seems to be falling apart, and that is a torturous decision. So I would say, in my entire career, I literally don't think I've ever seen anyone pull their money out at this amazing time and then put it back in at an even more amazing time. It almost never happens. The closest example I have is in my first year in the business in 1999. A guy took out a bunch of money from his 401k and bought a boat. And I said, that is an atrocious financial decision. Of course, when you take the money out, you sell everything. Well, in 1999, the market was very high, right? In 2000, the tech bubble burst. In 2001, September 11th happened, and the guy had a 3-year payback period. So he had basically sold at a super high rate, the market. And then when he was putting money back in over the next 3 years, he was buying at, discounts of 20 to 40%. And to this day, he's never let me forget about it. So even though it was on accident, because he really wanted a boat, he didn't really think the market was high. That's the only time I can ever think of in my career where it really, really worked out. In this time, what I think is to even further illustrate that point, in this time, this is over a 20-year period of time. Had you been fully invested in the market, from 99 to 19, your $10,000 investment would have made $32,000. Now, in that 20 years, there's about 5,000 trading days. 5,036. I'm going to look down, and be so weird just to look down and check my notes. 5,036 trading days in that amount of time. If you missed 10, not 10%, 10 trading days, you would have lost half of your profit. So even for someone who can sell at a pretty good time and buy in at a pretty good time, if that causes you to miss some of these big days, you're still going to get killed. So what I would encourage you is that and that's why we're doing this webinar now, because we've started to see some people suggesting moving to cash or doing other things. And I think it's probably one of the biggest mistakes you could ever make. Now watch, the market's going to crash tomorrow. But I think what this illustrates is if you miss even a couple, if you miss the top 20 days out of 5,000, right? Out of 5,000, right? The top 20 days. So less than 1% of the days, you didn't make anything, right? Your $10,000 turned into 10,200, and that's after 20 years of inflation, albeit low, some. So you actually lost money over those 20 years if you just missed the 20 biggest trading days. So my perspective is, if you're worried about the market, which I think a lot of people are, quite frankly, I personally am, going to cash is a mistake. And we're even going to come back to this a couple of different times. So going to cash is a mistake. What do? We're going to discuss 3 strategies. Strategy number 1 is rebalancing. Strategy number 2 is adaptive risk. And strategy number 3, strategy for inflated stock bond market. I will explain this in much more detail in a little bit. So number 1 is rebalancing. When you go to rebalance your portfolio, I would, the reason it's important is because of this chart. I love this chart. This is a Callan chart. It's one of the things that you see when you're like 17 years old and it really sinks in and I go, oh, this makes so much sense. We don't need to all be experts on the Callan chart by the end of this webinar, but I will explain it very briefly. This year is 2001. Each one of these colors represents a different piece of the investment marketplace. So like this is just fixed income, the most conservative. In 2001, you had September 11th. The thing that performed the best was fixed income, right? The most conservative stuff. High yield is kind of junk bonds, small cap, emerging markets, so on and so forth. And we'll talk about large cap a little bit as well. So I think the point is you don't know. No one knew September 11th was going to happen, right? Or at least very few people in the entire world. No one in the US. So you wouldn't have known to pick fixed income investments, which is why it's important that you have some in your portfolio all the time. I don't think after having 2 years of having been middle of the road to bad, that most people thought the next 5 years was going to be amazing for real estate and emerging markets. And as a result of that, they really overweighted to those areas in their portfolio. Probably very few people knew that that was going to be the case, which is why it's important to always have some of that in your portfolio. And you could kind of do that with almost any color, right? You thought real estate was going to be great here. Well, it was pretty good, but it was terrible this year, right? And terrible a couple of years before that. And you could do the same thing with everything, right? Did you know emerging markets were going to be down 15%, this year, or 55% this year? And you just completely avoided them? No, you did not. So rebalancing, there's actually a big study done by Vanguard that talked about the value of a financial planner and like where does a financial advisor add value? And one of the big areas was in rebalancing, because people, their natural predilection is to not rebalance, right? They want to keep buying the things that are doing well, and they don't want the things that are doing poorly in their portfolio. But that's the wrong way to look at it. You want to have a well-diversified portfolio that you rebalance into the areas. So in this year, had you rebalanced into emerging markets that had lost half of their value, you would have been richly rewarded by then having them go up 79% the next year, right? So by having a little bit of at least everything and then slightly trimming them, over time, which we do quarterly for our clients. If you have an LPL account, chances are we are rebalancing it for you. So we're rebalancing it for you. And then we're changing inside of that also the size of the pie. So you might not want as much emerging markets as you had last year, but you always want to at least have some allocation to them. And I'll give you an example of what that looks like. So I think people, I'm surprised how often they don't really understand rebalancing. So let's say this is your desired allocation, right? And we want 15% international. And international goes down. So by the end of the year or by the end of the quarter, you're down to 9% international. But small cap did okay. And it went from 15% to 22. What you want to do at that point is not buy more small cap, right? Small cap did well. That's great. We're going to take some of those profits and we're going to go buy some of the international that is now on a discount. People think that this is crazy because they view it as one security. Like, why would I keep dumping money into something that may be out of business or gone in a year? It's important to remember the category of international is never going to be gone. Every single international company is not going to go out of business, right? So the category of international will always be there. the category of big US companies will always be there. There will always be some companies based in the US that are big. Those names change, but you keep bringing people out and putting new ones in. Like I said, LPL, where we clear through, just got into the S&P 500. Tesla got into the S&P 500 either earlier this year or late last year. So as new companies get a larger importance in the overall economy, those companies will be added, and other ones that are shrinking will all fall out. In 1900, the whole S&P 500 is basically railroads, right? I don't think there's any railroads in the S&P 500 today. So the category is still here. The S&P 500, as you saw in that chart earlier, is still there and doing great. Just the names inside of it change. So as a result of that, the risk of buying something while it's down, it's not like buying GM when it was down before it went bankrupt, right? Where then you just lost everything. This is buying a category that will be there, you know? So I think rebalancing is really important, and that's how it works. And that's a strategy, you know, for our clients. You know, some of you on here might be not working with us yet, but for our clients that we're rebalancing, the bottom of the COVID recession was March 23rd of last year. We rebalance our clients' accounts quarterly. So within a week, you know, within less than 5 trading days, we had taken a ton of bonds that we had built up in 2019. So in 2019, Trump tax cuts, markets up 25%. Every 3 months, we sold stocks because this was happening, right? Small cap would go from 15 to 22, large cap would go from 35 to 47. And every 3 months, we said we have to pull that back and get back to an allocation that, number one, fit the client's risk tolerance and that we thought was efficient. By doing that for that year where the market was up, then when COVID happened and the market was down 40% in 40 days, what did we do? We took, in some cases, up to almost half of clients' bonds and dumped them into the stock market while it was down 40%. Well, it's up 70% since then, or something ludicrous. So that's good, right? So that rebalancing works. And if you do it consistently, it works relatively well. So I think in a time of people being scared of the market being high, I think that rebalancing is a way to not drift more aggressive as the market's going up, because you constantly pare back your equity to a level of risk that you're comfortable with. Strategy number 2 is adaptive risk. I think adaptive risk funds do what most people think a financial advisor is doing, but now no one in the country does. I think what people think a financial advisor does is they sit down and look at the economy and what's going on, and they sell, and they go into the client's account and they say, okay, this client was on a scale of 1 to 10 of 5 risk. Things look pretty good. We're going to take them to an 8, right? There's no financial advisor in the country that will do that, because if we are wrong as financial advisors and we take you to an 8, you know, without talking to you first, and then the market goes down for some unforeseen reason, guess who you are going to sue and who you should sue? Us. So no financial advisor in the world does that as a result of that risk. Adaptive risk funds do that. So adaptive risk funds look at your portfolio at a given amount of time. So, you know, some of them are monthly, some are quarterly, some are actually daily. And they can make changes to the risk level inside of your account. They can be wrong sometimes, which is why I don't think anyone should have 100% of their money into an adaptive risk fund. But maybe having an adaptive risk into like one of these categories here, if we made one adaptive risk and rebalanced into and out of it, I think that it can have a portion in a lot of people's portfolio, actually. So here's kind of how they work. They usually look at several different economic indicators, right? So maybe like economic condition, consumer sentiment, and market momentum are 3 of the common ones. If all of these are green, right, you could see the adaptive risk fund to go 100% aggressive. 100% aggressive would mean buying usually 50 to 100 stocks that are more risky than the overall marketplace. They usually define that by looking at something called beta. Beta is just a measurement of how much up and down, basically that a stock does. So if everything's green and everything's looking rosy, your adaptive risk fund may move you to very aggressive stocks. Then let's say one of these turn, like kind of consumer sentiment. Actually, University of Michigan does the biggest one in the world of consumer confidence. So let's say consumer sentiment, University of Michigan's is set at 50. So if it's above 50, it means people are confident. If it's below 50, it means they're kind of pessimistic. So let's say people are like a 47, on a U of M consumer sentiment, and that kind of turns red to the adaptive risk fund. They will sell your stocks that are super aggressive, and they'll probably buy some market about equal to the market. So a beta of about 1. So about the same volatility of the overall S&P stock market. Then let's say another one turns, kind of yellow or red and starts to concern them. they will then sell those stocks that are about market risk, and they're going to go with super conservative stocks. Think Coca-Cola, right? People don't buy much more or less Coca-Cola based on what's going on in the economy. Procter and Gamble makes toilet paper. DTE makes electricity. These are things that people use about the same amount of, no matter if there's a recession or not. So they'll kind of stick in stocks or maybe a little bit of cash, but they'll just be super conservative. If all three of them go red, it means some stuff's hitting the fan, and they can literally go to 100% cash. There are quite a few funds out there who no one missed COVID. No one saw a pandemic coming, but there are some of these adaptive risk funds that, COVID started to hit and only went down a little bit, and they got right out. Again, there are others that got out too late, right? It was more near the bottom, and then the market rebounded very sharply, and they ended up losing a little bit. But some got out very quickly. Others completely missed the recession of 2008. Like, the market started to turn a little bit. They saw some things they didn't like. Everything turned red. They went to cash for sometimes a couple of years. And the entire time the market was going down, they didn't really lose almost anything. So there are adaptive risk funds. Each of them works a little bit differently. And a lot of times we won't, because they all have kind of a different philosophy, we might even use 2 or 3 that all kind of complement each other. So you're not into one kind of strategy or philosophy. But I think adaptive risk funds are another way that in a market that's a little bit high, you can have some exposure to that would reduce your overall risk while still giving you a lot, if not all, of the upside of the market. Number 3, forward inflated market. Why I included this one is I like them a lot. And I think that sometimes, like in 2008, stocks and bonds move in the same direction. A lot of times, stocks and bonds move inversely to each other. That's been the historical relationship, but not all the time. So there's a lot of clients out there that say, hey, Jason, I want to stay invested in stocks. I'm not super excited about bonds, because I think bonds could also go down. It might be a little expensive now. So how can I invest in stocks and have some sort of protection? And they start bringing up options and hedged equities and things like that. So there is a way that you can do that is relatively simple. Myself, I do not feel qualified at all to kind of put together these combinations of things to do that, because you have to really understand futures and options. And quite frankly, I don't even know. I probably know 1,000 financial advisors. I can't think of one of them that I would consider that would do a good job with this. You want like a massive global bank like JP Morgan or Credit Suisse or HSBC or maybe Morgan Stanley, someone like that has a huge team of analysts, that has a lot of scale where people are putting in a lot of money to create these. And what they're basically doing is they're saying, we're going to put together what's called a call and a put. I know that's fancy pants language, and I apologize for that. I'll explain what they mean. When you sell a call, you are selling away some of your upside. So if you have a stock, and it goes up, let's say more than 9%, you don't get those gains anymore. So if the stock goes up 12, someone has bought those last 3 from you. So you get the first 9% in gains, but that's it. That's your cap. You have sold away, and someone else gets the gains above and beyond that. Well, for that, they paid you money. It's called a premium. You can then take that premium and buy something called a put. A put is a thing that protects the downside of your portfolio. So where I think that is super valuable is, here is the rate of return over the last 80 years of the stock market every year. So as you can see, these are the up years, right? There's some monsters. Right? I think there's a 50% in here. Yeah, 52% in 1954. So if anyone's around in 1954 here that was investing, man, did you do well in the 50s. In 1955, you also made 33. In 1958, you made 43. So this is a good time to invest in the United States stock market, right? So these are the rates of return. These are the bad years. What I think is incredibly interesting is there are 4 years where the stock market did worse than 14.7% out of 80. It's not that much. None of these years was a result of the market was just too high and it came down, right? All of them were extreme external shocks, right? 2002 was like the follow-on from September 11th, right? And the war on terror. 2008, we all know about. The 70s were, both 73 and 74, right? Were oil embargo. 37 was part of the, I think that was right when the Nazis took power, and it looked like we might have another war. Europe was doing horrible. There was hyperinflation, right? So everything was down. So the 30s, 1930 did not look great for that reason. But again, that's an external shock. It was not just because the market was kind of high. So when the market is just kind of high, it can go down. But historically, I can't guess the future. Historically, they don't go down by huge numbers. So again, if you could sell away a little bit of your upside and take the premium that the person pays you for that, and then buy protection on the downside, if that protection could be about 10%, you are going to cover the vast majority of losses that typically happen in the stock market. Even with some of these huge losses in here, on average, the negative years are only 12.5. So if you could sell away some of your upside, so again, you're not stuck in bonds, right? Because bonds may not make that much in the next couple of years. So if you don't want to be stuck in bonds and you want to stick with stocks, adaptive risk is a pretty decent option. I think another decent option is something like this, where you're selling away a little bit of your upside. So you're getting the majority of the upside, way more than you'd make in a bond. And you're protecting, let's say, the first 10% of your downside. I think that can make a lot of sense. So you do that in an index also. So the fees are really low, a lot less than a typical mutual fund, even our ETF. And you get the growth up to the cap, and then you get the buffer, which is the downside protection of 10% or more. So again, if you don't have any of these in your portfolio, and you feel free to reach out to your AQuest advisor. If you're on this webinar and you are not yet a client, feel free to reach out. We can explain it to you. Just see if it makes sense for your portfolio or not. So what I would say is going to cash is the enemy. The market is super high. I would say most people are worried about it. And there are three strategies that are obvious and can work in a lot of portfolios, which are rebalancing. Everyone should be doing that anyway. Adaptive risk, and then that third strategy. And again, on the bottom, no strategy assures success or protects against loss. If you think we put that in, you're crazy. That is also our compliance department. Really, really doing a great job. What I would say is that is about the end. I didn't want to go much more than about 30 minutes, so that's it. So anyone who wants to ask a question, feel free just to unmute. I think we had a lot of fall off for the second one because I think the weather's so nice. But if you want to ask a question, feel free to kind of just unmute and go ahead and ask. Vito, you unmuted? You got a question?
Hey, Jason, it's actually John.
Oh, hey, John. What's up, man?
How you doing?
Good.
I have a quick question about something that's not necessarily related to stocks, but the growth of decentralized finance, cryptocurrencies, yield farming. I know they're probably high risk, but what is your thought on that sector of the emerging market?
So cryptocurrency is not a registered security, and I am therefore barred from having an opinion on it. It's a question that everyone has. There's not that much, especially in a webinar, that I can say about it. Unfortunately, John, I'm kind of like, that's got to be the answer, especially in such a public venue.
Yep. No, I understand. Thank you.
Yep.
All right, I have a couple questions. Well, one is like for Jason, you're my advisor. So should I get with you and discuss ours and see if you think I need to do anything?
Yeah. So good. So, and that's for everyone on, whether you work with me or anyone else, I would say, shoot us an email or a call and just say, Joe, I could certainly after this, have someone put in a call to you and we'll schedule a time to talk in the next week or so, but yeah, this kind of stuff, like keeping up with people, because they're like your perspective, you're young, so a lot of times this is not something that we would have talked a lot about because you have a lot of time still. But if you're worried about this, then absolutely, this is something that we should be talking about for your portfolio.
Okay. And then the other question is, this is out of curiosity, since the market is doing so well, especially when you mentioned home selling. Yeah. I know these homes are like right now, people are getting insane amounts for their homes. Yep. If let's just say, I have my cottage. So let's just say I sell my cottage and I don't want to buy anything right now, can you take that and invest it and not pay capital gains? No. So if you have, this is true for everyone, anyone who has a second home that is not homesteaded. So if it's homesteaded, so some people, like we have a few clients that they actually file their tax returns separately so they can homestead both. But if you have not homesteaded your cottage or a place down, in Florida or wherever, and you go to sell it, whatever the difference between what you bought it for and what you sell it for is a capital gain. That capital gain is taxable.
there's a couple different ideas here. You can 1035 that, which is a fancy term that I can explain to you more individually, but it's a way that you can roll it into another property without paying tax. But so I guess I would say if you're thinking about buying another cottage, you could 1035 it that way, or excuse me, 1035 is something different, 1031 exchange. You could 1031 it into something different, but if you take it, you're going to have to pay capital gains. Now, capital gains might be increasing in the next year or two. So we do have a lot of people who are taking capital gains. If you make under $1 million a year, it might make sense to do that because some people are worried that capital gains taxes are going to go up. But if you sell it, that sale generates the capital gain. The way to reduce that capital gain, though, is to figure out what you bought it for and what you sell it for is typically what most people create as their gain. But what you bought it for, the fancy term for that is basis, right? That's your tax or cost basis. And if you sell it, that's what you get out tax-free. But you guys have done a lot of, and most people do a lot of improvements over time. If you can prove that you've paid for those improvements, you can increase your basis and then shrink your gain. So a lot of people spend a lot of time if they're going to sell something that is appreciated a lot, trying to figure out ways to increase their basis because it reduces or eliminates the capital gain completely.
Okay. All right. Makes sense.
All right, cool, Joe. Well, I'll have someone reach out to you and we can chat about, if any of this fits into your portfolio or not.
Okay. Yeah, I'm no hurry. I was wondering.
All right.
See what you thought. That's all.
Yeah. Anyone else?
Hey, Jason, I have a question. This is
Hey,
Joe.
Joe.
Yeah, with all this massive government spending, and we're talking big numbers here, multiple trillions of dollars, how is that going to affect the value of the dollar long term? And should we be concerned about that?
Yeah, I think my answer for sure is I don't know. But let me expand on that a little bit. The dollar can be eroded by creating additional money, which is basically inflation, right? And therefore the dollar can be eroded in value. That is probably something that can happen. The thing is, everyone else is doing the same thing. Right, so the U.S. is not in a bubble, right? There's been this, COVID and the pandemic is the whole world, and the whole world has stimulated their way. Even countries like Germany that do not want to do it have stimulated their way out of it. So I would say that I've had to change my language in this over the last couple of years as kind of society has changed. But the U.S. is the least ugly guy at the dance, right? Meaning, yes, we have inflated our money supply and we have this big debt, but like Japan has more. China, you don't even know what they're doing because you can't trust their statistics. England and Europe have created, they just transferred a ton of money from the wealthier countries down to the poor countries, which is the biggest one they've ever done, right? Ton of money. So yes, we are doing that, but we're still the reserve currency of the world. And we're not doing it really that much more than anyone else, because our economy has been growing due to all this stimulus, where other people's economies, Europe hasn't even recovered from 2008 yet, and we've done great since then, right? Because we didn't do austerity, we did stimulus. So yeah, our debt is getting a lot worse, but also our economy is getting a lot bigger. So everyone else is stimulating and their economy is not rebounding as much as ours. So it's a problem, but it's probably less of a problem than you think it is. And also, you live in the US, you buy stuff with American dollars. So where the dollar going down really affects most people here, right? Unless you're like going to Canada all the time. But where it really affects most people here is in inflation, right? Things that we buy from other places will take more of our dollars if our dollars are worth less. So if we import, an iPhone or, I think we're in Detroit, we all buy predominantly US cars, but if we import a TV, right, that TV is going to get more expensive if our dollar is weaker. But also, when our dollar is weaker, other people can buy our stuff easier. So you tend to export more, which is actually good for the economy. So I think if we were the only person, like Argentina has done this in the past, where Argentina just blew out their money supply by 50% a year, right? That will destroy their economy. But if we're at an inflation of 4% versus 2%, and everyone else is doing the same thing, it shouldn't really kill the dollar all that much. And even if it hurts the dollar a little, we might export more and it might even be good for the economy. So I think that maybe long-term, what are you going to do though? You're going to trust a communist China to have the reserve currency of the world? You're going to put Europe, who has like that union is very weak, that monetarily they're not as tied in. I mean, they all have one currency, but there's so many other things like budgets and debts and how they vote on things. They can't figure anything out. I mean, Britain just left. You're not going to use the pound. It's too small of a country. You're not going to use the Swiss franc. It's too small of a country. So what's the other choice? So again, we might be doing some ugly stuff, but we're the least ugly guy at the dance right now.
Okay, that helps. That's good.
Great, thank you.
Thanks.
Hey, Jason,
Hi.
how are you? Question for you on, you know, how we have to take out so much money every year from your 401k investments.
Yep.
So if Congress doesn't extend the TCJA and the tax rates go up after 2026, how are we going to protect ourselves with that?
That's a really good question. So just to explain it to the rest of the people, when you turned 70 and a half last year, you were forced to take money out. The government pushed it off for a year. So no one had to take a required distribution last year if they didn't want to. They also, the CARES Act changed the required minimum distribution age from 70 to 72. The TCJA, for those of you who might not recognize that acronym, are the Trump tax cuts, right? Correct, ma'am? That's what you're asking about? So what she's saying is actually a really good question, which is the tax cuts that Trump instituted a couple of years ago expire in a couple of years. So when those expire and you have to take money out of your IRA, you know, could you be getting killed on tax rates? And that answer is yes. We work really aggressively. We do have Jonathan Bailey, who's a CPA, you know, on our staff that works with us and a lot of our clients. So there are ways that you can take advantage of the rates today by doing Roth conversions. So you can take money out of your IRA and move it over to your Roth IRA and pay the taxes and kind of like lock in your tax rates today. I think the vast majority of our clients have actually done something like that. So that is probably the best way to do it. The other way is you can gift it. You can gift your required minimum distribution to a charity. I don't know if that, you know, that's not everyone's cup of tea, but it's called a QCD. You can do a qualified charitable distribution where you take you can only do it with your required minimum distribution, no more. But that required minimum distribution that they force out, you can give to a charity and you don't have to pay any tax. But the Roth IRA, or you don't even have to move it to a Roth. You could just do a distribution now and keep it in a savings account, right? A Roth grows tax-free, so I don't know why you wouldn't do that necessarily. So Roth IRA is probably the best. You can also gift some of that money to charity. And so when tax rates, I do think will probably go up, but the required minimum distribution, I think, will change a lot. It's already changed from it's been 70 and a half forever, my whole career. So at 70 and a half is what it used to be. It's already 72. And then there is actually a proposal in the House of Representatives right now that's proposing to move it to 75. And then there's a big chunk of it's very bipartisan. No one likes this. No one likes the required distribution. So they're probably, I would think they're going to move it to 75. And then I would think by the time most of us who are maybe in the early 70s on this call, by the time you hit 75, I think they'll just do away with it completely. The reason is when you used to be able to inherit money as a child, if you're inheriting from your parents or grandparents, you had your whole life that you could spread out that required minimum distribution, that IRA that you inherit as a kid, you could spread out your parents over your whole life. So you only pay a little bit of tax every year. Now that's gone. Last year, they changed that. You have to take it all out in 10 years. So I think the government's basically saying, why are we forcing these retirees to take out their money if they don't want it? And then if they don't take it, do you know what's the biggest penalty in the entire tax code if you don't take it? The penalty for not taking it, does anyone know what it is? 50%. Half of the money that you were supposed to take out, the government will just go into your account and take out as a penalty. It's pretty crazy. So so why are we forcing retirees to take money out that they don't want, penalizing them like crazy for no reason when their kids inherit the money, they'll have to take it out over 10 years anyway. So I think that's where the government is right now. Again, my best guess is they wait until 75 for your RMDs, and then I would think it's going to be gone. But the best thing that you can do is you want to talk with your advisor about meeting with Jonathan and looking at how to take advantage of the brackets. Like if your income is here and the top of a bracket is here, this amount of money should be moved over to a Roth. I shouldn't say should. May make sense to move it over to a Roth IRA to take advantage of today's tax brackets. I would say don't do it on your own because there's a lot of other questions. Like if you Roth convert too much, you could pay a higher Medicare premium. You could lose your property tax credit, earned income tax credit, a child tax credit. So by doing conversions, it drives up your income, which is good. But there's a lot of kind of like cliffs in the tax code that you can fall off if it goes too high. So I would contact your advisor, see if you can talk to Jonathan, and maybe look at converting is probably the most effective strategy.
Okay, so I have another question, a couple questions. Have you ever heard of the IUL insurance?
Yeah.
Is that a good place to?
Well, so an IUL is an indexed universal life. Universal life is a life insurance policy that lasts forever. Indexed means you can't lose any money in it in the investments, but you don't gain that much either. So an IUL is when you take the money out of an IRA to move it to the IUL, though, you have to pay tax. So the only tax that you're avoiding is once you put it in, then that money either goes to your heirs tax free, or if you take it out, if you follow all of the rules associated with it, it might be tax free as well. So an IUL is an okay place to do something like that. Again, it's hard for me to say yes, it makes sense for you. We'd have to look at. I help every advisor in the firm doing the strategy work. I've done the strategy work for 1,100 clients in our firm. So if you asked your advisor that, they would bring it to me, and I would then be able to say specifically for your situation, does it make sense?
So then we just need to make an appointment in, because we're gonna be selling our house, and we're not buying another one.
Okay.
And so we're gonna have this influx of cash.
Yeah, there's a lot of different. I mean, you could go life insurance with long-term care if you don't have that, which is similar to an IUL but with a long-term care component. You could do, a super tax efficient investment, that includes municipal bonds and ETFs that don't trade a lot, that don't provide a lot of capital gains. I mean, so there are things that are out there that could make sense. And when you call your advisor and tell them about it, again, that advisor will come to me. I'll sit down with my CPA and him, and maybe even an estate planning attorney that's in our building. And we come up with all of the ideas, and then they'll tell you here's what we think.
Okay. All right.
Thanks for your question.
Hey, Jason, I have another question.
Sure.
Joe. Okay, we've been talking for most of the hour about the stock market being at an all-time high, and equities and so forth. But also real estate prices seem to be at an all-time high right now. I guess, what are your thoughts about that, how it's connected to the market, and what people or experts are seeing down the road for real estate prices? I know it's mainly a supply side issue right now, but what are your thoughts on that?
Yeah, I think so. It is a supply side issue. You had a lot of household formation recently where before, and I think it was like a joke that millennials were all like living in their parents' basements and playing video games. So now a lot of those people have moved out because they have better jobs now, or they have gotten married and they have a house. So household formation has also exploded. Plus you have construction is super expensive, so you're not seeing as much of it. And it's harder to build things now, right? There's a lot of land usage requirements, that they wasn't around. Plus there's areas that are trying to slow down growth. Like Nevada just outlawed grass, right? They have no water, right? It's the middle of the desert. It's in the middle of the desert, and they have a couple million people living there. They have no water. So they're paying people to tear out their grass, right? So they don't have to water it. So kind of like where people are living and being able to build houses is harder. I think housing is high, but I mean, I'll tell you, I just bought, for those of you who don't know, this is like breaking news, but we bought a building in downtown Rochester this week. We're going to move our building from where we've been kind of forever to downtown in a building that I own. So it was a little bit more expensive, but I offset that with a really, really low fixed interest rate. So I think as interest rates go up, the rule of thumb, I believe, is for every 1% in interest rates increase, housing prices go down 5%. So as interest rates go up, I think that the price of houses will come back down. But Joe, I don't know if that's, is that 6 months from now, when these house prices start trending down. I think they're super high right now, but I don't know if it's 6 months or 2 years from now that they're going to start to come back down to earth.
Okay, so it's mainly going to be driven to interest rates, in your opinion. There's other factors, but that's certainly one that
there's some other factors. I think household formation, population growth, income growth. A lot of people. I mean, you understand. I mean, I went to my mom turned 80 this week and wanted to go hike Bryce Canyon in Utah for her birthday.
That's awesome.
For 80 is pretty good. And so I went out there, and someone I was talking to out there said, hey, you know, I fixed up part of my house, and then I got a tax return, and I got a credit because the child tax credits went up, and I got all the stimulus money, and I thought I was going to be like pretty stressed, but I've got $20,000 extra in the bank. I'm going to go redo another part of my house. You know, so I just think, again, the Americans are $20 trillion richer than they were a year and a half ago, and they're spending that money on stuff. You know, I'm redoing my garage right now. I had to move the bikes out of my basement because my whole garage is in disarray, and so I moved my bikes out for the Zoom because I didn't want it to look ridiculous. So, you know, everyone has a little bit more than they used to have, and they're spending it. And a lot of people, after being trapped in their house, realize their house is a dump, and they're trying to fix it up. You know, I'm the same. Parts of my house look horrible, and I'm like, I got to fix this thing up. So, so I think housing is going to stay high for a little while. In a post-stimulus environment, everyone's going to have less money, and housing is going to contract as a result of that. I just don't know when.
Okay. Thank you.
I'd like to make a little comment on that. I heard on the news or something, and I don't know if it's interest rate you're talking about, but they said that the government's not going to raise their interest rate or something until 2023.
Yeah, that's the Federal Reserve. They raise rates that are overnight, so they're actually only one-day rates, which are not super important. I mean, the Fed is buying and selling bonds, you know, buying a lot of them right now. That's the most important thing. The Fed rate, it was nice that Powell came out and said, we're not going to raise it, but it was a little bit of a bummer because before he said he wasn't going to raise it until 2024. So now it's twice in 2023. So he's trying to put the brakes on the economy a little bit because he realizes it's overheating. You know, he sees the inflation and he wants to make sure that it stays down.
Yeah.
So he's not forced to raise rates too much.
So I didn't know if that tied in with the housing. That's what I was just bringing up.
No, the housing is more of the 10-year treasury, where the Fed controls only rates that are one day. So they're correlated a little bit, Joe, but not all that much. But thank you for bringing that up. That's like newer news. All right, anyone else? All right, great. Well, thanks, Bob. I love the AOK sign I get from Bob all the time. It's the whole reason I pay him to be on here, just to give it. So I appreciate it. All right, everyone. Well, thank you so much for your time. I really appreciate it. Again, if you have any questions, don't hesitate to reach out to your advisor, you know, or whoever it is that you work with at AQuest. And I really appreciate your time. Everyone have a good one.
Thank you. You too.
You too, Jason. Thanks for the webinar. Appreciate
No
it.
problem, Joe. Thank you.
Thank
Thank
you.
you.
Bye-bye.
See you, Kyle. Anyone else? Amazing. I've never had, well, I guess we have one question, but that's the least we've ever had. So that's great. Well, everyone, please, there's still some sunlight left. Thank you so much for spending a beautiful evening with us. I'm sure it was not the number one thing you were going to do this afternoon. So please go outside, enjoy it a little bit. And I look forward to seeing you all sometime soon.